that NFT gets locked up, you get a certain amount of rewards. There's various different differences in the details of various different staking systems and how they're implemented, but that's the general gist of it. And the high-level concept here is this is a way to take your NFT and guarantee that it's going to be off the market, that it is not going to be sold, that you are holding onto it. And therefore, when a lot of the holders all do this at the same time, it lowers the supply of the NFTs. And of course, when you look at the macroeconomics behind it, generally, the lower supply that you have, over time, the higher the price of the NFT gets. So it's kind of a win-win situation for all of the holders because it generates a scarcity in the supply of the NFT. And that's kind of the number one reason why people build out these staking systems is ultimately to create this scarcity. Now, of course, the other side of it is, hey, you need to give people an incentive for actually locking this up, right? Because most people, especially when they talk about minting NFTs, selling, flipping NFTs, there's a concept of liquidity, right? People have a finite amount of dollars, and they buy a finite amount of NFTs with it, and sometimes they need to liquidate, aka sell, some of their NFTs in order to get more Solana or more dollars to go and buy the next mint or to go and buy the next NFT. And so that's kind of an opportunity cost for those owners of the NFTs. And so as a reward, NFTs that are staked often generate some sort of token or some sort of quote unquote utility back for the owners that are staking it. Sometimes this is airdropped directly to your wallet. Sometimes this is a claim system where you need to go to a special staking webpage and then sign in with your wallet and then claim your token rewards and then they get sent to you. But basically the general gist of it is you lock up your NFT, you wait a certain amount of time, you get some certain amount of token back. And the really interesting thing here is it's not really the fact that you get a token back. When you think about all of the holders getting tokens back, it kind of turns this little token, which, for most Solana NFT projects is kind of just a token that's made up. So it initially doesn't really have any value to it. But because there's now a microcosm of an economy behind that, all of a sudden there's utility to these tokens. There's a economy where people trade and sell and exchange these tokens. And all of a sudden, you actually have something that, has some degree of value over it. And you begin to realize that this is a kind of a microcosm of economy where all of the same rules of micro and macroeconomics still apply. So we'll get into that a little bit later as well. So in case what I just said wasn't super clear, this is a super high level diagram, as simple as I can draw it. That's kind of how staking works. You take your NFT, you lock it up in a vault, and that's a transaction that you need to sign with your wallet. And then you wait, and then finally you get rewards. But that's as simple as I can kind of distill this down to. And so staking in the NFT space is often talked about hand in hand with something we call utility. And so in order to kind of go a little bit deeper on that, I'll give a quick intro to tokenomics. And by the way, for everyone on the call, feel free to raise your hand. If you have a question, just jump in. I can't see Discord, and Discord unfortunately doesn't have a hand raise option. But feel free to unmute and just say, hey, I have a quick question, and then we can stop and we can get those questions addressed. And so when we talk about staking and utility, the important thing to remember is this is a little miniature economy that we're talking about here. And what is the fundamental aspect of every economy? It's supply and demand. And when we talk about supply in the NFT space is a really interesting concept because unlike real dollars, these NFT stake tokens that get created for staking, they're free to make, or they're essentially free to make. You can go and create a Solana SPR token mint program. You can mint yourself 1 token, you can mint yourself 1 million tokens, you can mint yourself 100 million tokens for the low price of a transaction fee of 0.0005 cents. So it's essentially free. And that poses an interesting question here, because when you have such an overabundance of supply, especially free supply, it's really, really hard to assign that supply value, right? If I can think of it as just kind of inflation on steroids when it comes to regular dollars, right? Yes, the US government printed $2 trillion worth of cash over the last 2 years. What if they printed $200 trillion of cash? What does that look like? That means all of our US dollars are now, 20x, 100x less valuable because the supply is that much greater. Now, take that to the extreme when it comes to these staking tokens, and that's kind of what the fundamental problem that a lot of NFT projects need to address as part of how they design their tokenomics is, hey, we have a huge amount of initial supply, so how do we kind of build a dam on this supply such that there's only a small trickle that comes into circulation at any given time? And that's where the concept of what's called an emissions rate comes out. And an emissions rate is really a calculation of, okay, how many NFTs do we have? How many holders do we have? How much time do we want people to hold up these NFTs? Balanced with, okay, what are going to be some of the utilities that we want these tokens to offer? Basically, how do we make sure that there's a use to these tokens such that they get burned and therefore get taken away from the supply? And then the emissions rate is basically the variable that you can adjust that takes into account, okay, if I have 100 holders and I want each holder to hold it for a month, well, the math becomes pretty simple. If I have 100 NFTs outstanding, people hold it for a month. If I have an emissions rate of 1 token per day, I can pretty clearly do the calculation of 30 times 100, and then therefore that's how many tokens I will have in the total economy available to all of my stakers at the end of that month. So now all of a sudden you've built a dam. There's now a slow trickle of coins coming into your economy, and it's very, very calculated. It's very easy to calculate the supply and project the supply at any given time. And now is how you can start designing your economy. You can start talking about, okay, what does it mean to inflate the supply? What does it mean to deflate the supply? Of course, the best tokenomic systems always have something that is deflationary. Simply having more and more incoming supply is never really sustainable, unless somehow you're talking about Dogecoin, in which I don't know. Well, I guess that just somehow works out because there's always more people interested in buying. But generally, you need to have some sort of deflationary aspect, some sort of system whereby people can use your coin and therefore take it out of the supply, such that the overall supply over time doesn't run away out of control. And so that's kind of tokenomics 101, tokenomics in a nutshell. There's many, many layers to this. And it can start out very simple, and it can very quickly get very, very complicated. As kind of just a quick illustration of just how complicated it can get, as part of the Builder DAO ecosystem that we're building in partnership with Honey, Fellowship DAO, Dope Pandas, Gold Panther DAO, Panthers in the Metaverse, a few other projects. We're actually onboarding a Harvard PhD economist to actually help design our tokenomics, because there's again, this is basically parallels a real economy. And think about how many different levers and switches and fine-grained controls a regular economy has. The token economy has just as many. And so making sure that we're actually able to balance and tweak and really, really design and fine tune this economy, that's going to be super, super key to success. And in a little bit, I'll talk about just kind of how do we go from kind of an initial startup token economy where things are more or less worthless, and how does that kind of snowball and over time turn into an economy where things are actually have value, and how do we kind of convert something that's quote unquote Ponzi-nomics, which seems to be a very, very popular these days with Solana NFT staking, and how does a Ponzi-nomics economy actually eventually over time turn into a real economy? So we'll get into that in a little while. So pros and cons of staking. I think the pros are probably pretty easy to understand. The cons, they may surprise you. I think off the bat, the pros, I think everyone understands, hey, I get token rewards. Whether or not these tokens are worthwhile to hold, whether these tokens have value, they're still tokens, right? Even if they're not worth anything today, maybe they'll be worth a penny each tomorrow. Maybe they'll be worth 2 cents each tomorrow. And now all of a sudden, if I get airdropped 1,000 of them, 10,000 of them, hey, it's a few dollars. It's passive income, doesn't hurt, right? There's also staking schemes that on top of actually getting coin rewards, you get community rewards. So very popular thing is, hey, the community might airdrop a percentage of revenue share, or might airdrop actual dollars or actual Solana into a random person's wallet that is staking. And now all of a sudden it's, on top of all of your coin rewards, you're now entered into all of these airdrop prizes, and sometimes they may actually be pretty significant. So it's a good it's a good incentive to stake. Now the cons, this is something that people need to kind of just make sure they're aware of. These are not deal breakers, but if you're not aware of them, you can't make good decision making. So you have to be aware of them. Number one, I think this one everyone gets, is that these token rewards might be worthless. They might not be, but there's a good chance they might be worthless. That's okay. The security risks of staking, that's actually very, very important. In the diagram I mentioned earlier, what happens when you stake your NFT is you're actually approving a transaction to transfer and lock up that NFT in a vault. And the more secure staking systems, that vault is basically a vault that's created on demand just for you. No one else has access to it. You can't guarantee that all the staking systems are designed securely in that way, and you can't really guarantee and audit all of the staking contracts to make sure that there's no security flaws. In fact, there's already been some pretty major security flaws reported with staking, especially on Ethereum, where generally people's NFT values and their wallet values are a lot higher. There's been a couple of staking systems, even with coin staking, not just NFT staking, where people have found bugs in the contracts, and as a result, they've been able to exploit them and basically do unlimited withdrawals and steal people's money. And so security is always a concern. At the end of the day, any time where you don't have direct control of the wallet and the private keys, there's a risk. And when it comes to staking, that is kind of a pretty obvious risk there, because generally you do not have control of the vault, because if you do, it's not really locking it up. So that's something to keep in mind. Finally, especially if you're in the US, tax implications. If you use any sort of crypto tax software, one of the things that you'll very quickly realize the second you connect your wallet is every single token that you stake, every single stake that you get rewarded, it shows up as a taxable transaction, and so you need to classify it as income. This, especially when taken hand in hand with the first bullet of token rewards might be worthless, may not actually have a significant impact on your actual tax situation. It's probably not going to make or break your taxes. It's probably not going to bump you into a higher income bracket. It's probably not going to be a big cost that you'll need to pay as part of your taxes. But it's a huge headache. And the reason why it's a huge headache is generally these rewards are airdropped on a very frequent basis, and you need to go in and you need to document every single one of them. There's a couple of tools that can do it in bulk to help save you time, but at the end of the day, especially when you look back over the year, trying to go and classify for every NFT potentially hundreds of transactions, it's a total pain in the ass. And really the number one monetary cost here is when you look at these crypto tax tools, like crypto coin taxes or coin or whatnot. One of the things to realize is that their pricing model is based on the number of transactions in your wallet. And so usually, we don't really have too many transactions. I'm not buying thousands of NFTs every year. I'm not trading back and forth between coins thousands of times. But these staking rewards, even if I own just 2 or 3 NFTs, all of a sudden, every single day I get a couple of coins airdropped to me that may be worthless coins, but they still count as transactions. And now all of a sudden at year end, when I'm trying to do my taxes, I no longer qualify for the free plans. I now need to upgrade to their professional plans, which all of a sudden is $199, $299. And boom, there goes all of the money that I would have made with these staking coins. Now I gotta pay the tax tools. So again, your tax situation may be different, but again, just important to keep this in mind, especially if you live in the US, since we seem to have some pretty stringent tax rules when it comes to crypto, at least for now. So just to keep in mind. Moving on. Ponzi. What's a Ponzi? You might hear this all the time. Hey, this is a Ponzi coin. This is a Ponzi scheme. This is Ponzinomics. What is Ponzi? And the simplest way of understanding what a Ponzi is it's a system where the value to existing members that gets returned to them through staking, through API or APY or whatnot, it's actually not coming from revenue, but it's coming from what new members have to pay to become members. So, for instance, if you guys are familiar with a couple of famous Wall Street Ponzi schemes, basically what those investors promised is really, really high returns, like something like 20, 30, 40% returns on people's investments. Now, of course, that's not sustainable. You can get a couple wins here and there in the market, but year over year, no one is making 40% returns on Wall Street. And so what those people did was they said, hey, for the people that are really, really early, in order to maintain that 40% return, we're going to go out there and we're going to recruit a whole bunch of new customers to give us their money, and we're going to invest it. But before we invest it, we're now going to pay off what we owe to our founding members so that they can hit their 40% returns. And now you can kind of see that hey, actually what's happening is they're not making new money. They're kind of just reallocating, aka stealing money from the people who are joining to give it to the people that have already joined. So that's kind of what a traditional Wall Street Ponzi scam is. Now, people apply the word Ponzi to NFT staking, and especially using that word, it might potentially sound really bad. But the one thing to remember here is, where is the money coming from? When it comes to Wall Street is denominated in dollars. And so every dollar is a real dollar. It has to come from somewhere. It comes out of someone's pocket. It comes out of someone's investment account. When it comes to NFTs, these tokens are printed basically for free. So on the supply side, you're not necessarily stealing from anyone. What's happening is you are just giving them something that doesn't have value, or at least doesn't initially have value. And so to answer the question of who's paying for the staking rewards, these staking rewards are basically being paid by the creators of the coin, because the creators of the coin don't pay anything to create these coins. And so that's how you can get a lot of these airdrops and stuff of a lot of coins basically for free. Now, the thing to keep in mind though is eventually you want these staking rewards to be worth something. And so how does value get assigned to make these worthless coins actually worth something? There's a couple of ways. Number one, probably the most legitimate way, is projects talk about revenue sharing. For instance, actually the mint that we just posted in the Top Secret Alpha channel, if you are a Lost Cat holder, MetaHelix, their plan is to reward holders of their NFTs with actual revenue. So MetaHelix, they have an actual product. It's a Discord bot that does verifications of NFTs and automatically assigns roles, and they do a whole bunch of other things. And in order for projects to really make use of all of its full suite of features, they charge something like 3 SOL to get people set up. And that's, when you look at how many customers they have, that's a pretty nice little revenue stream that they got going on. So what their plan is they're going to take a portion of those proceeds and they're going to distribute it to their pool of NFT holders. They have 5,555 NFTs in their first generation, so they're going to split that profit across all of those people. And that's kind of how you can identify that, hey, this is not a Ponzi, because there's actually external income coming into the project, where you can now distribute that in a very real way to holders. Now, the thing that you got to keep in mind when you identify whether a project is Ponzi or not is you got to really just follow the money. Like, who's paying for the staking rewards? That's probably the number one question. And kind of the number two question is, who is paying for the staking liquidity? Right. Oftentimes, the staking rewards, especially if they're using a random coin, they get printed for free. But a lot of projects, especially when you look at how are they initially funding the liquidity pool, where's that money coming from? Make sure that it's not coming from their mint, because what that means is basically it's kind of a self-fulfilling cycle where there's really no external money coming in beyond additional people who are also going to be wanting to claim tokens for their reward. And so it's not a sustainable cycle. But if it's coming from something like royalties for trading, if it's coming from something external like actual product revenue, then all of a sudden there is an engine that can drive real value over time, and that is sustainable, or at least as sustainable as the business is still profitable. So that's super, super high level of kind of what is a Ponzi, how do you identify a Ponzi. And of course, there's the biggest question of all, are Ponzi's bad? And I think that kind of depends on who you ask, and it depends on the details of how the tokenomics are actually designed. They can be bad, they can be very bad, especially if the team is misleading in their messaging and not clear and upfront about what is actually going on with their tokenomics. A lot of teams, especially, they try to kind of hide the fact that they may actually be a Ponzi coin, Ponzi token in the beginning. And that lack of transparency is kind of almost always a bad sign. Generally, people who have good intentions, they don't need to hide their good intentions. Now, that's not to say that all Ponzi tokenomics are bad. Again, like I said at the beginning, the number one distinction between Ponzi tokenomics versus actual Wall Street Ponzi schemes is that tokenomics are not denoted in dollars. And because they're not denoted in dollars and they're based on a coin whose supply can be printed, you're not, at least off the bat, you're not stealing from anyone that is quote unquote buying in. So from that perspective, morally, it's less bad. From a legal perspective, I would argue it's less bad as well, although to be perfectly transparent, the SEC has not actually made any clear black and white delineations, and they have not investigated anyone. They really haven't had any coverage here at all, mostly because all of this is happening in real time. It's so brand new, but we'll await what the SEC has to say about this. I suspect that there's going to be some very clear requirements that they will have as far as determining whether or not a coin or a token is a security, and whether that it is determined to be a security or not is going to have implications on what you can do with your Ponzi-nomic system, and whether that ends up being good or bad. It's going to be a function of that. But ultimately, at the end of the day, I would say there are some very legitimate projects out there who are very upfront in saying, hey, in the early days, when they have not yet had the revenue stream all up and running, when they still have some product development work left to do, they want to light up staking ahead of time. Yeah, in that little interim period, it's probably technically a Ponzi-nomic scheme. But over time, especially when the teams are up front and they're talking about, hey, they're going to add real utility to these coins, they're going to fund a liquidity pool with actual revenue or actual royalties, and not just the mint dollars from additional mints or from the existing mint people, then all of a sudden there is a path to legitimacy there. And so, it's, again, the kind of the overarching theme with everything related to tokenomics or economies in general is the devil's really in the details. At a high level, this is kind of the picture that we're painting. Of course, when you look at various different projects, they all have, some of them have multi-page white papers. Some projects they go very, very deep in depth into the details. So it's really hard to just kind of say with a very broad stroke that yes, all of these are good, no, all of these are bad. It's, the devil ultimately is in the details, and kind of a key to really assessing that is to make sure that you are equipped with the tools, or at least at the high level knowledge of what these concepts are, so that you can kind of figure it out, at least get a gut check within yourself. Now, I know this topic got super complicated super quick. I'm going to pause for one quick moment, see if anyone has questions, and then if not, we'll start wrapping up with a couple of remaining topics. So if you do have a question, feel free to unmute. All right, going once, going twice. All right, let's move on. I know this was a topic that actually had a few votes, and so I figured we might as well cover it a little bit. How do you exactly do your own research? And this is kind of, applies to NFTs in general, but also this certainly applies to understanding what exactly is a healthy token economic system versus what is something that doesn't really have legs or is not sustainable. Number one thing you should always do is just identify who is the customer in the scenario. If you can't identify who the customer is, chances are it's probably you. And it's not always a bad thing to be the customer, but it's just always good to be conscious of who it is, right? This is very similar to, years ago when people were talking about Facebook, and Facebook is giving everything away for free. Who's the customer? Who's the actual customer? Turns out it's not the users; it's the advertisers are the actual customers, and you are the product. And so, being conscious of who is the customer, who is the product, is always just an important thing to an important part of research to just make sure that you are clear and you understand. Number two, of course, is where is the money coming from? When people give out staking rewards, when people airdrop money to random contest winners, whenever there's something of actual monetary value involved, ask yourself, where is that money coming from? And that will really, really, more often than not, help you get to the root of answering the question, is this sustainable, yes or no? And especially if it's a regular occurrence, like, hey, every single day people get airdropped one Solana. I hope they're really making a lot of revenue, because otherwise they're going to go broke quick. And right, so answering those type of questions very quickly gets you into a nice little mental model of, is this sustainable, yes or no? And then finally, think about scale. Think about, does this economy work simply because of how small it is? Does this economy work if there were 1 million people in it? Does it work with 10 million people in it? And this kind of helps answer the question of just the longevity and just kind of the economies of scale, and just kind of whether this economy actually has legs and can survive over time, or whether it eventually hits a death spiral and things come crumbling down and it's a house of cards. So especially when it comes to just kind of how, for instance, how is revenue shared? How is money just sent and airdropped to people? Just doing this calculation not only helps you get a sense of just where is this project going in the long run, but it also helps you assign value to the project as well, right? Especially because a lot of tokenomics has a direct correlation to the listing price, the floor price of the NFT. So when you think about in the long run, are they going to issue more NFTs, and therefore is there going to be more holders? Is there going to be a really, really big secondary market of people who just want to deal with the coin that's airdropped and not the NFTs at all? And what does that look like when there are more holders of the coins and there are holders of the NFTs? Like, all of those questions, they kind of just help you get a sense of what the scale of the project looks like. And then finally, it's always good to ask the question, what's the weakest link in the system? For instance, when you think of a simple staking economy, oftentimes the weakest link is actually in the staking contract, or the weakest link is in the how the devs have built the website. And this is both a security question, because generally you just need to compromise one weakest link and you've compromised the entire system. But it's also an economics question because you kind of get a sense of, okay, who are the big and small players in the space? Who are the people that have power, are able to make the market, versus who are the people that don't have power and are just getting kind of a little token of appreciation to get them feel like they're bought into the system. Always good to have that context in your head. And then finally, just some high level general DYOR themes. Always know who's backing the project, who's promoting the project, especially if it's getting a lot of influencer coverage, knowing the nature of these influencers. Are they getting paid? Do they have some sort of cut of the revenues? Blah, 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 whatever that deal looks like. It's just good to understand that you can kind of take all of their marketing in context. Of course, it's always good to have an understanding of who are the winners in the system, who are the losers. No one wants to be the bag holder, but unfortunately, most of the bag holders don't know they're holding the bag until it's too late. So the earlier you can kind of suss this out, especially if you can actually realize this without buying into it, the better. And so again, having an understanding of all of the above questions, the tokenomics, the team, the project roadmap, all of that helps you kind of suss that out. And then finally, of course, trust your gut. These are things that apply to not just NFTs, but everything in general. If it's too good to be true, it probably is. Or if it's too good to be true, you probably missed the boat, one or the other. Don't follow the hype. This is probably the hardest rule to follow in the NFT space because everything has so much hype behind it. Sometimes the hype is just deafening and blinding, and you can't help but fall into the hype trap. That's totally understandable. We're all humans. We all get influenced one way or another, whether we like it or not. But again, the difference is whether you consciously know that you're following the hype versus you're unconsciously getting caught up in it and don't realize you're getting caught up in the hype. So just always just kind of make sure you're able to take a step back and assess. And then finally, my advice to anyone, whether this is investing, whether this is quitting their job to do a startup, don't go all in. I know it sounds counterintuitive to a lot of what these motivational speakers will tell you, but here's my thesis. When you think about investments, when you think about businesses and doing startups and being an entrepreneur, when you think about almost anything in life, it's almost always a numbers game, right? The first 9 out of 10 startups that someone does are just statistically never going to be successful. So when you think about it that way, why do you want to go all in on your first of 10 when really what you should be doing is thinking about, okay, how can I set myself up so that I can be at bat 9 more times so that I will get my 10 out of 10 and so that the odds are going to be in my favor, right? Now, that doesn't mean you don't go all in from a passion perspective, but from a lifestyle perspective, from a dollars perspective, you make sure you're not over-invested. Make sure that you can live to see another day, so you can live to make another trade. You can live to do another startup. So that's kind of a thesis that always resounds pretty closely to me, and that's a pretty strong basis for how I think about my investment and my startup journey. And then just wrapping up now, this is probably going to be a slide that you're going to see pretty often at all of our future learn and grow sessions. And you're going to see this pretty often because it's very, very important, especially in these early days of crypto and NFTs. Security, security, security. Always be conscious of what you're clicking, who is sending the messages and what they're actually saying. Hackers, scammers, anyone who's been part of a mint probably has dealt with, malicious or suspicious messages, fake links to fake mint sites, etc., etc. Hopefully you haven't been scammed, but if you have, it's not, it's a pretty common occurrence, so don't feel too bad about it, but of course it still hurts, so just be careful. Fake coins, fake NFTs, those can be very, very nefarious, because smart contracts oftentimes, especially if you don't have a technical coding background, it's hard to really understand what those smart contracts are actually doing. So there is absolutely the chance that, hey, your wallet might get drained, or you might be inadvertently sending your NFTs to some other random person. We've all heard about, a couple of really, really bad mints that happened this week where people did get their wallets drained. So just be extra, extra careful. And then, of course, taxes, especially if you're in the US, probably Canada and a few other countries as well. Just always be mindful of them. Don't let taxes stop you from doing NFTs, especially because there's oftentimes a pretty strong profit motive behind NFTs. But just be careful. Make sure you're doing your taxes. I know it sucks to do taxes, especially since it's tax season right now. But it's better to spend a few extra hours up front to do them right, rather than 4 or 5 years later come back, get audited, and somehow having to dig up all of your previous records and give them to the IRS. That's a total pain in the ass. So just try to take care of it up front. There's some nice tools. Unfortunately, not all of them are free, but especially if you're making profit in the NFT space, it's worthwhile to spend 1 SOL, 2 SOL maybe, just to make sure you're all sorted out and totally legal. And with that, this is basically the conclusion of our second session. If you have any questions, feel free to raise your hand and just jump into the chat. If not, again, I'll be uploading a copy of this deck. Actually, it should already be uploaded. And then we'll be uploading a recording of this video to YouTube as well. And if you are watching this on YouTube, please like and subscribe and hit that notification bell. All right, if there's no more questions, then I guess we'll call it for today. Thank you everyone for joining. I really appreciate it. I love how you guys are engaged with us, with our project. I love how we have a nice little community of learners here. And I just love all of the positivity in our community. So thank you again. Looking forward to delivering more, especially with the announcements that we had this week around the build ecosystem. We actually have a few more announcements teed up, not ready to share yet, but we do have a lot of really exciting plans, really just awesome product plans that are very unique. I don't think anyone in the space is really thinking about product the way that we are thinking about product. And so hopefully I'm looking forward to sharing more of that with you all very soon. So thanks again for joining us. Take care, guys.